Now let's look at the items that go into the plan assets. And to do that, we're going to look at this exercise 3. The following data relate to Polar Company's defined benefit pension plan. So it tells the plan assets to begin the year were 660. Then it tells us the expected return, the actual return on those assets, the contributions made to the plan, the amortization of net loss, the pension benefits paid for the year, and the pension expense was 79. Now in this problem, it doesn't tell us all the information we need to do a full pension because they're only asking for us to calculate the pension assets at fair value at the end of the year. So they're just wanting one single number here. And they're not going to break down the pension expense to explain interest and service costs because we do not need that to find the plan assets. So let's talk about that just a little bit. There are 4 things that go into plan assets. They're the benefits paid, the expected return on assets, the actual return on assets, and the contributions. Those are the only 4 things that impact our plan assets. Some of them are self-explanatory. Let's start with contributions. That's the money the company puts into the plan asset. So it's sort of like you contribute to a 401k. You put $10,000 in your 401k, you've contributed money. Benefits paid are the amount that retired employees have withdrawn, or benefits that we've paid out to our retirees. That's pretty self-explanatory. Now the next 2 are pretty easy as well. Expected return is what the actuary thought we would return. Remember, when we record this, we may not know our full return yet. So we actually put our expected plan asset returns when we're calculating it. And then our actual returns is adjusted in our plan assets at the end of the period so that we can see, oh, we expected this, but this is what we actually had. So expected is what the actuary had included in our pension obligations. Our actual return is the amount of money we actually made. So the actuarial numbers will come out at the beginning to tell us what we expect, and then we'll see the actual at the end of the year before we book the actual entry. All right, so let's look at these 4 components and see if we can come up with our plan assets. First and foremost, we're going to start with our beginning because it wants to know our fair value at December 31st. So we'll start with our beginning plan assets. We had $660 million. That's where we started. Now notice plan assets, that's positive because it's a debit here. PBO, a positive, is a credit. So these 2 columns I actually treat that way. Okay, so 660, that's a increased number, that's a debit balance for us. Now the 4 things, so let me just highlight the 4, get on the right rows. These are the 4 items that actually impact pension expense. See if I can highlight that really quickly. Well, I'm in Microsoft Word on a Mac, and I'm really not sure how to highlight them. But anyway, that's the 4 areas. It might help if I blew this up a little bit. There we go. There we go. Just had to find the right button. Word for Mac's a little bit different than Word for PCs, and I'm used to Word for PCs, so my apologies there. So those are the 4 items that's actually going to go into our plan assets: benefit paid, expected return, actual return, and contribution. So let's find each of those. So first and foremost, let's talk about our contributions. That's the amount of money the company put into the plan assets. They put in $110 million. So we would increase our plan assets by $110 million. Then let's do the next easiest one, that's benefits paid. How much did we pay out? It said that pension benefits paid for the year were 12. So now keep in mind, when you pay out benefits, what will that do to my assets? Well, when you pay out, it makes your assets go down. So we're going to reduce our overall assets, or credit the assets if we were to journal each of these individually. Now, next is our expected and our actual return. Well, to find pension expense, we put in our expected at 66. That's what we expect to have return on our assets. Sometimes they give us the number, sometimes they give us an expense, or a percentage, excuse me. So we expected a return of 66. Now, the actual return on plan assets was 53. Now, here's what you do not want to do. You do not want to go in here and put 53 because you're double counting. Your expected return already includes that 53. That 66 would say, hey, we expected 66, we only made 53. So when you go to adjust for the actual return, what you're going to want to do is the difference between your expected and your actual, which was 13. Notice these 2 netted together will give you the 53 overall return. So don't put 66 and don't go in here and say, oh, well, I expected 53. We understand that. This actual return is to bring your expected down to actual. So the sum of these two is what you want to show at 53. Now, why in the world do we show them separately? Well, we show them separately because expected return is actually part of our pension expense, whereas the actual return is not. The actual return then would be part of the amortization of net gains or losses. So it's going to go here, and it will be amortized over time. It does not get recognized all at once as expense, okay? So we have to be careful with that. These two items we report separately on here because they are journaled separately when we go to journal them. All right, so that's all we need to know for pension assets are those 4 items. So go down here, that tells me we're either going to increase our asset or decrease it. And in this case, we're going to do the sum of those 4, and we end up with 151. Again, that's a net debit position, so we're increasing our assets. So we're taking our assets from 660, we're increasing them by 151. So at the end of the day, I have $811 million in my plan assets, so that would be the answer here, $811 million. I always use these worksheets to help me solve them because I know in these worksheets, let me just show you, these first 5 items, they are part of our pension, or excuse me, our projected, I keep wanting to say pension instead of projected, our projected benefit obligation. Then the next 4 items here, they're part of your plan assets. Then to get your pension expense, remember it's your service, your interest, your expected return, your amortization, and your amortization of gain or loss. So those are the 5 pieces. So once you have all these and you know them, you can calculate the journal entries for all of your pension related problems. 5 items go into my PBO: service cost, interest costs, prior service cost adjustments, actuarial gains or losses, and benefits paid. 4 items go into my actual plan assets, that's my benefits, my expected return, my actual return, and my contributions. And then there's 5 items: service cost, interest cost, expected return, and our amortization there that goes into pension expense. If you can remember how to calculate each of those components, you should be able to come up with your entry every single time. All right, so that concludes exercise 3 here. Next, we'll look at some more in-depth exercises that actually have us creating the entries for all of the components.